Hey everyone, are you ready for a roller coaster ride through the world of finance? Hold on tight, because today I'm going to reveal the secrets of turning tough times into treasure. Ever wondered why some people get richer when the economy takes a nosedive? Well, I've got the insider scoop, and you won't believe what I've discovered. From the unexpected moves of big players like Warren Buffett to simple strategies you can use right now. This video is packed with golden nuggets that could change the way you see money forever. So grab your notepad and let's dive in. Trust me, you'll want to stick around till the very end. There's a surprise tip that could be your game changer in weathering economic storms. Let's get started. Hard times in the money world often lead to huge falls in the market, and just the thought of a recession can make folks really worried. But did you know that Warren Buffett, a super rich man, actually gets excited about these hard times? I've been learning from him and other top cash wizards for ages, and now I understand why. I'm going to let you in on this secret in this video, but first, let's ponder this. Are we heading into a rough time in the money world? Is a massive market fall coming? You're probably more curious about how to earn cash when times are tough and the market takes a dive. The last 3 years have been wild. The illness that spread far and wide has brought us to this point, with too few jobs, really high prices for homes, climbing costs for things we use daily, difficulties in getting goods from abroad, an unstable economy, and the worst inflation in a long time. What does all this mean, especially in the USA? Right now, inflation is through the roof. The Federal Reserve, our big economic bank, thinks it's way too much and plans to increase interest rates. This is delicate because tweaking interest rates is super tricky. If they mess it up, it can lead to big troubles. Here's what interest rates do. When they're low, it's cheap to borrow money. Folks spend more and the economy gets better. That's what the Federal Reserve did during the lockdowns. But when they hike the rates, borrowing gets pricey, people spend less, and the economy slows. If the economy isn't prepared and they hike rates too quickly, it can start a chain reaction here and globally. But the Federal Reserve knows the danger and is being extra cautious about their next step. However, history tells us they haven't always nailed it in these situations. Now let's simplify what a recession is. A recession occurs when the total value of everything a nation makes, which is the GDP, drops for 2 straight quarters. Now, let's chat about something called GDP, which is all the goods a country produces and services it offers in a certain period. We should really examine the GDP figures, and the most recent numbers are quite eye-opening. In the last part of 2021, the GDP for the year shot up by 6.9%, ending with an annual rise of 5.7% compared to 2020, when it fell by 3.4%. So it looks good, right? But are we missing something in these figures? Here's where it gets gripping. Most of this GDP rise came from companies making more goods, not from more people shopping. Looking at the manufacturing sector, there are fresh orders, but the increase in these orders is slowing significantly. Even the major investors and the folks on Wall Street are beginning to doubt that the US will grow much in 2024. There's another hint that a recession could be close, something that signaled every US recession in the past 50 years. It's called the yield curve. This curve deals with US government bonds and shows different interest rates for these bonds depending on how long you hold them. For example, the interest rate is different if you hold a bond for 5 months or 5 years. Usually, you'd expect a higher interest rate for holding a bond longer because the risk and uncertainty increase over time. But when this curve turns upside down, it's a serious signal. It means something's not right, and you'd get more interest for holding the bond for a shorter period, which is odd. This flip in the yield curve happens when investors are very worried about what's coming and think a recession is around the corner. But let's be clear. No one can say for sure when a recession or market crash will happen. Not even the smartest financial brains with lots of education or years in finance. What really grabbed my attention is how some folks become really wealthy in tough times. So I studied almost all the big investors, from Benjamin Graham to Warren Buffett. Now I see why Buffett actually welcomed recessions. It's about this idea. Be fearful when others are greedy, and greedy when others are fearful. These successful people who made money in the 2008 crash followed this principle. Even though stocks were low, house prices were dropping, businesses were struggling, and people's savings were vanishing. Let's examine what went down in 2008. Imagine if you had invested $20,000 in the S&P 500 just before the 2007 financial crisis. If you panicked, like most people, and withdrew your money around May 2008, you would have lost about 31% of it, leaving you with just $13,800. But if you had applied some of the tactics I'm about to share, you could have ended up with nearly $50,000. Making money when the market crashes sounds easy, but it's tough. When you see everything dropping, fear sets in, and you think about selling, and online, you find folks advising you to sell and wait to re-enter after the crash. But here's the catch. Trying to time the market perfectly is unrealistic. There are two big guesses in this. First, you believe you can spot when the market hits rock bottom to sell at that moment. Second, you think you can predict when it will start rising to buy back in. Without a magical way to see the future, predicting these things is a guess. A University of Michigan study examined the market from 1963 to 2004. They discovered that nearly all the best ways for making money happened on just 0.85% of all trading days. A leading stock expert analyzed the market for 10 years, from November 2005 to October 2015. He found that if you missed the 10 best trading days in those 10 years, you'd lose about 66% of the profits you could have made by simply staying in the market. The key point is that when the market shoots up, it happens really quickly. If your cash isn't in the market, you might miss the golden days for earning. So don't fear the market and stay calm. But what's the best move when times are hard and you're getting nervous? 3 words: dollar cost averaging. This is an investment method where you spend a set amount of cash to buy shares regularly. For instance, imagine you invest $200 in Microsoft each month for 5 years. By doing this, you snag more shares when the prices are low and fewer when they're high. In the long run, you end up paying less on average for each share. Here's how it works. You've got $300 to invest in a stock with fluctuating prices. In month 1, each share is $10. In the second month, it falls to $5. Then in month 3, it soars to $20. This is where dollar cost averaging shines. You decide to invest $100 each month for 3 months. So in the first month, you grab 10 shares. In month 2, when it's cheaper, you get 20 shares. And in the third month, with higher prices, you get 5 shares. After 3 months, you've gathered 35 shares with your $300. This makes your average cost per share around $8.57. It's not the lowest, because in 1 month it was just $5, but it's not the peak either, which was $20 in the third month. Some research suggests that investing all your money at once might yield better results over time, but in tough times, like a recession or market crash, that's hard due to fear and uncertainty. That's why I recommend dollar cost averaging during these unpredictable periods. One study showed that people who dumped all their cash into the stock market during a recession lost about 22.4% of it. But those who invested gradually only lost around 17.6%. This 5% difference is significant. On a $100,000 investment, that's $5,000, enough for a lot of McDonald's cheeseburgers. So what should you invest in during a recession? A diversified index fund is a simple option, but not all stocks drop when the economy is shaky. Some actually thrive, and it's possible to identify them. During the 2008 recession, some stocks defied the downturn. For example, Dollar Tree saw a 60.8% increase. Walmart earned a 20% return, and Ross, selling affordable clothes, gained 17.6%. The healthcare sector also performed well, even in hard times. People still need essentials like food, clothing, healthcare, and financial services. It's crucial to trim unnecessary expenses during a recession to maximize your earnings. Economic downturns are more common than many of us realize. They're just a standard part of the economy's cycle. Since 1945, we've experienced roughly 10 downturns, and usually they go on for about 11 months. The markets always recover in the end, but you need to be wise with your finances before you begin investing during these downturns. Thanks for watching, and remember, your path to smarter investing and peace of mind starts with one step. This video is for educational purposes. Always research and consult experts before investing. If you enjoyed this, check out our next video, subscribe and share your thoughts in the comments. Thanks for watching and see you in the next video. Here's to your investing success. Profitable investing.